In this video, we're going to take a look at FEPI, which is the Rexfang and Innovation Equity Premium Income ETF. I've gotten a lot of requests to go over this fund, and I see a lot of praise for it here on YouTube and other websites like Seeking Alpha. One person even described it as the new cornerstone of income ETFs, which is quite the praise for it. And that's despite the fact this thing has only been around for less than 1 year at this point. The biggest appeal of this ETF is the extremely high yield, which is currently at 25.2% as of the making of this video, and it also pays monthly distributions. So let's take a look at this ETF and see if it's worth all this hype it's been getting. Their funds page oddly doesn't have a lot of useful information on its strategy, so we'll have to dig a little deeper. According to its prospectus, it says that FEPI is an actively managed ETF that seeks current income first while maintaining the opportunity for share price growth. The securities in this ETF are a part of the Sole Active FANG Innovation Index. I've never heard of this index, so I did some research and this is what I found. It says the Sole Active FANG Innovation Index includes 15 highly liquid stocks that are focused on building tomorrow's technology today. The index is comprised of 8 core components, which includes Apple, Amazon, Meta, Alphabet, Microsoft, Netflix, Nvidia, and Tesla. It also holds the 7 top traded names across the following fact sheet industries, which you can see include a lot of potential sectors. So ultimately, this index will only hold 15 companies at one time, and you can see the others that haven't been mentioned yet include Palo Alto Networks, Adobe, AMD, Salesforce, Broadcom, Intel, and Micron Technology. Apparently, this index has been around since 2014, and you can see this index has crushed both the Nasdaq 100 and the S&P 500 over the course of its existence, so that's definitely encouraging. To have a covered call fund use an index like this that's seen these kind of share price returns gives you hope that we'll not only see good share price appreciation, but potential dividend growth. There's a couple things that I think investors need to take note of though before considering FEPI as a potential cornerstone investment if you are seeking high current income. If you know me, you'll know that I like diversification. 15 holdings just isn't enough to make me feel comfortable to make an investment like FEPI a cornerstone of my portfolio. It's also going to result in this ETF being more volatile in share price than much larger indexes, like the Nasdaq 100. But that doesn't ultimately mean that it's not worth considering for at least some space in your portfolio. Second, this index has never gone through a prolonged tech bubble. In the early 2000s, we of course had the dot-com bubble burst, and as a result, the tech-heavy Nasdaq 100 plummeted in share price and it didn't fully recover for more than 14 years. Given how this is a covered call fund and upside is capped to a certain degree, I would hate to see how FEPI would do during another large burst like this. However, this is going to depend on you personally and what you believe about the sector. You might believe that tech still has a tremendous amount of upside potential still, or you might believe that tech is very overvalued right now, which would make you think twice before considering an ETF like this. What I wanted to know is how exactly this index picks the securities that it does and what percentages they allocate to each holding. They have a guideline document on this index's website which provides more information. It says all 15 positions must have a market cap of at least $10 billion to be considered. That appears to include their core holdings, which I guess never change. Unless I'm not reading this correctly, all 8 of these positions will apparently never lose the index unless they fall under the $10 billion in market cap. The next step involves them taking the top 30 ranked stocks by market cap and picking the top ones based on their 12-month average daily value traded. It says the top stocks are selected for the final index, starting with the highest ranked security until the final number of 15 stocks is reached. In terms of weighing each component, it says that each selection day and review day, each index component is assigned an equal weight. The index is rebalanced monthly and reconstitutes quarterly in March, June, September, and December. So now that we know how it selects each holding, let's take a closer look at this ETF strategy. This fund doesn't use a synthetic covered call strategy like YieldMax or Roundhill Investments ETFs, but rather a more traditional covered call strategy. It says, the fund strategy is to create long exposure to the index by purchasing and rebalancing all of the stocks in the index and to generate income by selling call options on the stocks included in the index. The fund seeks to generate current income from option premiums by writing covered call options on the fund's portfolio securities. The writing of a call option generates income in the form of a premium paid by the option buyer. The fund's investment strategy is to write call options that are slightly out of the money, which will allow for some capital appreciation as well as income generation. The degree to which the fund's written call options will be out of the money when written will depend on market conditions at the time. However, the fund intends to target written call options that are not at or in the money. When looking at the performance of this ETF, I thought it would be useful to compare it to another ETF that is somewhat similar. The fund that came to my mind was QQQI, the NEOS Nasdaq 100 High Income ETF. It's another covered call fund that I think is likely the closest thing to FEPI that exists. There are going to be some big differences, such as the yield being quite a bit less, but QQQI holds all the same stocks as FEPI, and they also heavily allocate towards tech. The NEOS fund is also different in that it holds 100 holdings and is taxed differently through using 1256 contracts, so this comparison isn't going to be perfect, but we will compare the total return for each ETF though. From a share price perspective, let's now take a look and see how both ETFs have done over the past 6 months. The blue line is FEPI and the yellow line is QQQI. You'll see that both are down because the Nasdaq and just tech in general has been pretty volatile over the past 5 or 6 weeks, but FEPI is down almost 5 times as much as the NEOS fund. Again, since it holds fewer stocks, it'll likely have more dramatic share price movements. Both ETFs have provided a positive return since being launched, but as of currently, QQQI's share price has been a lot more stable. I suspect a good reason for FEPI's share price underperformance is likely due to it holding a large amount of Intel stock. Almost 7% of this ETF is made up of Intel, and they've been going through some pretty significant headwinds. As you can see, they're down almost 55% in 6 months. Their stock did meet the qualifications to be included in this index, but eventually it will be replaced with a better performing company. Let's now take a look at each ETF's dividend distributions. Starting with the NEOS fund, QQQI, you'll see that its dividends have been pretty consistent. In their most recent month, they paid almost 65 cents per share, which was an all-time high for them. But that was because of the volatility in the index last month. Their dividends, though, have always been between 60 and 65 cents per share. FEPI's dividends have been slightly less consistent, ranging from $1.20 per share to $1.08 per share. Not a big difference. It could potentially make budgeting slightly more difficult if you own a lot and you're living off the distributions, but up to this point, I think it's mostly been fine. Just like the share price, I would expect FEPI's dividends to be a little more volatile as well for its smaller portfolio. Let's now compare the total return of each fund. FEPI was launched in October of 2023, and QQQI was launched in January of 2024. So we're going to compare the total returns of each fund, starting with QQQI's starting date for a more fair comparison. We'll also look at the total return of FEPI in a little bit. We can see in the last 7 months or so, QQQI has delivered better returns up to this point. The NEOS fund returned 7.89% and FEPI returned 2.41% during the same time, and by the way, both investments had the dividends reinvested back into buying more shares. So we can see that for QQQI, it has been the better performer despite yielding quite a bit less. But now let's look at FEPI's total return since that ETF was first launched. You can see thanks to it being launched when tech was still doing much better than recently, it's delivered pretty outstanding returns. If QQQI had the same start date, who knows what kind of returns we'd be looking at. But from a total return perspective since its IPO, FEPI has done really good. So to summarize, I think that FEPI does have good potential. Given the fact that it's less diversified, I would be hesitant to call it a cornerstone investment of an income portfolio. My plan for right now is I'm going to stick with QQQI for the time being, because another thing I like about this ETF is that it's more tax efficient. Because of its use of 1256 contracts, a portion of its dividends are classified as long-term capital gains, and thus they're taxed at a lower amount. I'm also a believer that I think tech is a little bit overvalued right now, and I haven't bought a whole lot of QQQI in the past few months. But with that being said, that's going to wrap up today's video. If you'd like to connect and also see what's inside my own personal dividend portfolio, then feel free to check me out over on our Patreon, where you'll receive updates and be able to talk to me and other higher yielding dividend and income investors. But with that being said, thank you all so much for watching today's video, and until next time, take care.